Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through a bunch of different ratios. I haven't done this in a while. What a ratio is an asset priced against another asset. So it's an asset divided by the asset compared to history. What this tells us is a couple of things. It tells us what's expensive, what's cheap, depending on where the ratio is compared to history. It also tells us the market conditions that we are in. If certain assets are outperforming other assets, it tells us the market condition we are in. And it gives us an indicator of perhaps how much further valuation-wise we could run compared to history. Just because something is expensive or something is cheap doesn't mean that it will automatically adjust quickly. The market conditions determine when these adjust. So ratios and market conditions are intertwined. They move when the market conditions change, and the market conditions change and humans start to interact differently. So market conditions are what change the ratios, but you can use ratios to gauge the market conditions because they only move during certain conditions. So I think we are still very early in a lot of these moves. That's why the ratios are so stinking cheap. And I'm going to make comments along those lines as we go through it, if something's cheap or expensive compared to history. What I do in a strategy and approach that I take, just so everybody understands, is I use the ratios to determine the valuation of an asset compared to history. These valuations just go back and forth against each other, like a sine wave or a cosine wave. It's the same thing, just depending where you start. It just cycles back and forth. That's all it does. Back and forth, back and forth, back and forth over long periods of time. The highs of the ratios may not always be the same, and the lows may not be the same. But what we're trying to do is capture the majority of the move of a very undervalued asset that appreciates in other asset terms. So again, what does that mean? What it means is you're growing your true purchasing power of other assets, which is what you want as an investor. So, for instance, you could have a dollar price go up, but if your dollar price goes up and it can't purchase more of another asset that you want to buy, your purchasing power has gone down. That's not what we want to be in. That you're not making purchasing power gains. So the whole point of this is to get into assets that are cheap against other assets so you can buy more of those other assets. That's the whole point of it. And it's an objective way to say, yes, this is cheap, or no, it's expensive. It's that simple. So to sum it up one last time, asset versus asset, it's proposed as a ratio. That's why I call it ratios. Compare it to history. It tells us when something's cheap. It tells us the market conditions and when they could potentially be changing. And as they change and you find a very cheap asset that appreciates against everything else, that's the asset you want to generally prefer. And we can apply technical analysis to these ratios. Let's dive in. I'm going to give you my financial opinion. Again, just because something's cheap doesn't mean it will change immediately. It may take some years for that to change and ride and turn. All right, let's dive in here, and I'll give you my opinions. So I'm going to start with platinum divided by the gold ratio. We're going to work our way through a bunch of different assets. So platinum to gold, historically, the average of this ratio is somewhere like 1.2, 1.3. And that's that white line going across in the middle there. That's the historical average around that area. But we are at 0.5. 0.5 is ludicrously cheap for platinum. So when looking at history, I don't think platinum's ever traded at 0.5 for this period or length of time. And I know a lot of people, why? Why is platinum cheap? Well, some people attribute it to the Volkswagen diesel scandal, where platinum is used mainly in diesel catalytic converters, and they said, you know what, we're going to stop selling as many diesels, and there's a shift, perhaps, but that was what one of the reasons was for platinum going down. But platinum's used in a whole bunch of different things. And whenever something's cheap, generally people engineer it into products, etc. Right now, platinum is substituting palladium because of the ratios in catalytic converters for gasoline engines, not just diesel. So platinum's cheap to gold. I don't think it's ever been this cheap, ever. 0.5. Platinum in relationship to palladium is also incredibly cheap. I would say the average ratio, it's a little bit below this, is somewhere in this range around 3 to 1. Right now we're at 0.8, which is really cheap for platinum. So platinum is cheap, palladium is expensive. Platinum versus silver, platinum is cheap against silver. And I know a lot of people make the claim, well, silver's the cheapest asset on earth. Well, technically it would be platinum because platinum is cheap against all the other assets. It's even cheap against silver. It's at a 40 to 1 ratio. And that ratio was up around 150 at some periods of time. So we're at a pretty cheap ratio. It's not the cheapest ever. I think the cheapest ever got in the 20s before, but it's still very cheap. Gold to silver ratio, silver is very cheap against gold. In this ratio, we're at 86. I would say more of a fair value compared to recent history. If I were to throw a horizontal line through here, it'd be probably around 65 or so. 65 or even something a little bit like 60 or maybe even a little bit more like 50 when you take a longer term approach. It could be more down here for a long term approach, taking into account the early 1900s. The metal comes out of the ground. Some people say 7 to 1, 8 to 1, 9 to 1, somewhere in that range. And they think that it should be priced as such. I have a very differing viewpoint on the way that assets should be priced. It shouldn't be priced off scarcity. Scarcity alone, I should say. It should be based off of the demand and supply of that material. Something can be scarce but absolutely worthless. And something could be plentiful but be worth a lot based off of its applications and the willingness that people are going to pay for it. But silver's cheap. It has kind of broken to the upside, but we are seeing some signals where we could move lower in this ratio. And I'm holding my judgment in the short term at this time. I think silver is going to outperform, which is going to drop this ratio. That's what I think over a period of time. Palladium versus silver. Silver's outperforming palladium. We've got a decline in the ratio, and silver's the denominator. So generally speaking, at the bottom here, this is a great time to accumulate palladium as this longer term bottom here. It's great to swap into silver at these tops here. Silver generally outperforms palladium. And what that is telling us is during a technology boom or the recovery phase of real estate, the recovery phase and where tech stocks do real well, palladium generally does real well. That's these areas here. So recovery phases, palladium outperforms. After recovery phases, more of the expansionary commodity booms, that's when silver takes off. And this is more indication that we're in a commodity boom because silver's outperforming palladium. I think platinum outperforms palladium also in that type of environment, and it's doing that. Dow Jones versus gold. We had some massive moves from 1980 all the way to the peak of the dot-com bubble up here. That was a massive move where interest rates went from a very high interest rate to a very low interest rate. And we had a mini boom in commodities at that time there. What I think is going to occur is that we are going to break this to the downside. That's my take on this. We're going to break to the downside based off of higher interest rates and a commodity boom that's coming. That we're in, I should say. That is coming and that we are in. Inflation drives this lower in an expansion phase of real estate. Gold versus Dow Jones. So what I did is I flipped the ratio around so you guys can see it. So this is the ratio flipped around. This is really just one big double bottom. And we have recently broken this downtrend line that I've drawn in and done a little bit of a retest here. Here's our retest coming back, and then I think gold's going to rip to the upside. That's my take. So gold, I think, will eventually work its way up here and then work all the way back up. I say that based off of the producer price index to consumer price index ratio, which we're not going to go into at this time. But I think we're going to see a strong outperformance of gold versus Dow. Gold versus crude oil. How cheap is crude oil? Cheap as heck. 25 is the ratio. So 1 ounce of gold can buy 25 ounces or 25 barrels of oil. Now, when we look at history, just to show you guys previous history, the last bull market for oil peaked in 2008 at this ratio at 6. We hit 6 here. We hit 6 here. This would have been a very difficult era to see where to buy oil at. Now, if you notice in 2000, oil was at a ratio of 8 to 1 in the beginning of the last bull market of commodities. And that ratio has stayed very, I'll say, compressed to the downside during that entire time frame. Recently, we were at a ratio that went to like 100, 200. That's when the price of oil traded negative. Right now, if I were to expand this, 24 is at a really cheap ratio, which means crude oil is very cheap to gold. We go to crude oil versus nat gas. Nat gas has been riding a very cheap area ever since shale kind of kicked in real big. We've been pumping a lot more natural gas. In terms of supply demand, we've been more of a glut phase than a shortage phase. Back here, we were pricing natural gas more like a 1 to 8, 1 to 6 ratio. The energy content to oil is 1 barrel is 6. So 1 to 6 is the energy content. And right now we are at a cheap 22.9, but we were at 39. And it's starting to come back down. This would have been a great time to be looking at natural gas. Crude oil versus gold. What you can see here is crude oil outperformed gold during this period. Gold outperformed crude oil during the recovery phase from 2008 all the way to 2020. We've broken out of that pattern, done our retest in terms of this ratio. And what I think is coming is going to be a large outperformance of crude oil versus gold when a highly inflationary period comes. This could still go down in the short term with interest rates for a period of time. And again, guys, I'm not trying to play the short term here. What I want you to walk away with is we have changed this downtrend into a new uptrend. So crude oil is probably going to put in a large outperformance of gold. And you can even like throw this in here and think of this as one big like shoulder, head, shoulder that's developing. Crude oil versus Dow Jones. So crude oil versus stock, it's that same kind of double bottom type pattern. And I think that crude oil will eventually outperform Dow Jones. We're at a very low ratio right now. Dow Jones versus crude oil, I just flipped it. Last bull market, and I'll show you guys what that looks like here. So we came on down with crude oil outperforming. We broke that downtrend line. We came back up, and then we compressed further. What we're going through right now is basically the same thing. We got this large negative price movement, but we came on down, we broke it, did a retest, and now we're compressing back down further to the downside, where crude oil is going to outperform the Dow. Dow Jones versus natural gas. You can see this going back and forth, and the volatility of natural gas is increasing with time. We're having higher highs up here and higher, and the lows are remaining very low. I think that this is going to go all the way back down and compress all the way back down here at some point where natural gas outperforms the Dow Jones Industrial Index. TLT versus gold. This is bonds versus gold. You can see an outperformance of gold. No reason to be in bonds, in my opinion. We've got gold versus bonds flipped. So gold outperforming, bonds outperforming, gold outperforming. This has been the era for gold, basically. This is the copper to gold ratio. Generally, the 10-year yield follows this. Similarly, the big moves up and downs. We have had a disconnect here recently, but gold has been outperforming copper here recently. That also is expected in a highly inflationary, stagflationary environment. And some people think that gold's going to outperform copper in this environment. Swapping to a lot of uranium stocks, I'm going to take a bigger picture view. Uranium looks like it's going to basically beat everything. Uranium still looks fantastic for outperformance against silver. It looks absolutely fantastic against the S&P 500. Strong outperformance there. I like these past candlesticks. Massive breakout there. Uranium versus gold. We're seeing an outperformance of that. To me, this looks like just a little pullback. And then I'm going to see, my guess is another gigantic outperformance of uranium. Uranium versus crude oil. That's been outperforming here recently. It's been moving on up. Looks good. Uranium versus copper. Uranium's been outperforming copper, and it looks like that could continue. Uranium versus nat gas. Now, nat gas has been holding its own here, and I'm not sure if uranium's going to outperform nat gas. I think it will, but nat gas could be another one that could compress depending on the weather around the world. Uranium versus Dow Jones. You can see an outperformance of uranium as it's starting to break to the upside for uranium. Uranium versus platinum. Uranium looks like it's going to outperform platinum. And uranium versus the M2 money supply. And uranium is outperforming the M2 money supply quite dramatically with a nice big double bottom there. So one thing to sum up after going through the uranium against all the other assets, uranium should be one of the spots that you should be looking at for potential investment. Hopefully you're already in it because it's outperforming everything else. Looks absolutely fantastic. We can also look at nat gas because nat gas is a really cheap one, and it's starting to outperform everything. So nat gas has been outperforming. We're just going to fly through this. Nat gas versus platinum, nat gas versus gold. It's been outperforming gold. Natural gas versus uranium. You can see that obviously it's been a pretty tight match there, back and forth. Natural gas versus crude oil, a little bit of outperformance there. It's starting to come back into that pattern. We're at a very cheap level. Natural gas versus copper. Natural gas is obviously outperforming copper. This has a very weird, like 1, 2, 3, 4, 5, 6, 7, and maybe this breaks all the way back up. And you get these kind of accumulation cylinders where they kind of go back and forth, and then it starts to break. I think it's a similar type pattern in the ratio, and that natural gas could outperform copper, hopefully, very dramatically. Natural gas versus Dow Jones, you can see a long-term squeeze of it. We've broken out, we've done our retest, and now I think it's time for nat gas to appreciate against the Dow Jones Industrial Average. This was an appreciation phase here, that big phase there, going up there. This is a decline in a different environment. So this was your expansionary phase of real estate, this was your recovery phase, this was your recovery phase, and now we're in an expansion phase. And I think we'll probably go higher. Natural gas versus palladium. We've been outperforming palladium here, but we're still at incredibly low levels. Natural gas it's super cheap. Natural gas versus Baltic Dry Index. It's cheap. It's moved up a little bit, but I think both of these will do quite well. You can see that they're basically well matched through history. So that's where I'll end it. I'll end it there. That's a lot of different ratios there. What's the key takeaway after looking at all this? There's a couple of things. There's a couple of assets that are really cheap. Natural gas is one of them. We just went over it. Pretty cheap. It is starting to try to turn up, but it could remain cheap for a while. It's a long-term investment. And whenever something's very cheap, what people do is they'll substitute the cheap thing. If crude oil is more expensive than nat gas, they'll burn nat gas if they can, where they can. If coal gets expensive versus natural gas, they'll burn more natural gas. If something else is cheap, they'll substitute whatever they can. And that's what's happened over time. Generally, you get substitutions, you get market conditions that swing it too far to one way versus the other. It can go below the cost curves. Natural gas is below the higher cost producers. So in my opinion, natural gas is going to go higher. Platinum is also another one that is cheap against all of the other metals. That would be one for potential investment. So platinum, natural gas, and then you can also look at uranium, which is basically outperforming everything. So that would be another one that I would be watching, and I'm already in it, and I'm watching this stuff start to move. And obviously, there's other sectors that we could look at. There's iron ore, there's steel, which is a component of iron ore. There's Baltic Dry Index that we didn't go over. Baltic Dry Index is another one that's very cheap. When you look at gold, gold is cheap against a whole bunch of different assets. It's cheap against the M2 money supply. It's cheap against stocks. And it's also actually the housing, when priced in gold, housing, the real estate market's cheap when compared to gold, surprisingly. Actually, real estate is cheap compared to all the other financial assets. Weird as that is. But that's where I think all the opportunities are, is where this stuff kind of kicks out. Now, what I do next is I go into another layer to see what the sectors are doing priced in dollars. Then I dive in again and look at the individual companies, look at the ETFs. You can even play the ratio games where you price the individual company divided by the commodity itself, and you'll get potential, buy points based off of that. What you want to find, and I call this a dream within a dream within a dream. What you want is full alignment. You want, and I'll just describe the dream. Okay, we had a dream set up in 2020 with oil. We had gold that was cheap to all the other assets. Gold's cheap to S&P 500. Gold's cheap to the M2 money supply. Gold's cheap to basically anything that you price it against. Then when you priced gold in relationship to crude oil was off the page cheap. Like total anomaly in history. Like what the heck just happened cheap. Then you priced the companies, the individual companies, the ETFs, whatever you want to price it in. And you price that against gold. And here, I'll show you guys what that looks like. So just take gold divided by the M2 money supply. So this is gold divided by the M2 money supply. And during that time frame in 2020, the dream looked like this. This is cheap down here for gold. Gold in an expensive state would be up here. So gold has basically not accounted for the money supply. And what that tells me is that we're in the wrong market conditions for gold to appreciate. But in my opinion, we are coming into the market conditions where gold's gonna kick some butt. I'll just say that. So gold's cheap to the M2 money supply. Then what I looked at the gold to crude oil price. So this is the gold to oil ratio. And what we saw was the gold to oil ratio went off the page here. It went to, it says 200 and something, but it went negative. So you really had an opportunity in crude oil in 2020 because, I mean, it went negative, guys. And if it goes negative, that means that there's 0 oil companies in the world that could make a profit when crude oil goes to 0 or negative. So the companies absolutely ate crap during that time frame. So did natural gas. So we knew that crude oil was cheap to gold, and gold's cheap to the M2 money supply, and gold's cheap to basically all the other financial assets. So then I said, okay, what about XOP divided by crude oil? There we go. So XOP in 2020 went to a very cheap level down here. You can see in October this incredibly cheap ratio of XOP versus crude oil. And what I think we're going to see is this ratio really start to kick it to the upside, where XOP starts to outperform crude oil. And you can see right here, you can see it's starting to break to the upside with that outperformance. I think this is just basically a big flag pattern coming up here. It's a flag pattern that's going to kick to the upside. So XOP is going to outperform crude oil, and you could have bought this at a level that was down here in October of 2020. Just absolutely, it was at 1. And right now we're at 1.83. So basically XOP has doubled against crude oil, and crude oil went from 0 to 80 something dollars that we're at today, 82 or 3 or whatever it is. So huge outperformance there. Then you could even take some of the individual companies. What I played is crude oil versus natural gas. I'll show you how cheap it was. In 2020, we were up here. If crude oil was cheap to gold and natural gas is cheap to crude oil, what I could do is I could play the natural gas companies. And what I did is I played SM Energy, which at that same time was right here in October of 2020 in a falling wedge against natural gas. And that's where my entry point was right here. And that's been the appreciation of SM Energy against natural gas. So what I played was, it was actually like 4 dreams within a dream. It was like the ultimate setup that I've ever seen. So what that means is you had Dow Jones. Gold's cheap to Dow Jones. Gold's cheap to M2 money supply. M2's up here. Then you go to gold, and crude oil was cheap to gold. Then you go to natural gas. Natural gas was cheap to crude oil. Then you go to SM Energy, and SM Energy was cheap off the page to natural gas. What that is a multi-leveraged ratio bet where, in my opinion, at some point in history here, or some point in the future, all of these ratios are going to flip to the opposite side, where natural gas will be expensive to crude oil, and crude oil will be expensive to gold, and gold will be expensive to financial assets. So that's going to be a huge unwind, and money's going to chase it all because money chases returns. That's really what it is. And that's the dream within a dream within a dream within a dream. That's how I played it. And when you see those alignments occur, when you go for it, swing for the fence. So that's what I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel. If you guys are interested in this type of investing and learning how to do it, sign up to finding-value.com. Become one of the members. You can use discount in the coupon code. We've got a 5 p.m. Mountain Standard Time question and answer session where you can interact with me directly, ask me questions, ask me how I learned this or whatever you want to know, or how to do it. I do this, and these are a lot of the companies that I purchase are very similar to this, my approach, and we've got good ideas all over the place. Steel companies, Brazilian steel companies, all these different areas where when things look pretty good and we get, I'll say, windows of opportunity to accumulate, that's when I accumulate. No one's going to be perfect. No one's going to be able to time it to the day or the month even. But if you can get pretty close within a few months of a really good entry point, and you're patient enough, when it unwinds, that is something to experience. That's what I'll say. It's something to experience where your account does crazy stuff. And some people, I think, have experienced that a little bit with uranium and some of the entry points where we really take off. Maybe it's 50, 60, 100% in a very short period of time. It really blows their hair back, even blows my hair back. Think about that. But yeah, the entry points, they're pretty good. Depends how much risk you want to take. If you're super speculative, I'm not. I like the cash flow companies, the opportunities where something just gets mispriced in the market based off the market condition. They've got the infrastructure in place, and it's just one big leverage play to a big move of the commodity or the service day rate, whatever it is that they provide. But yeah, that's what I've got, guys. Hopefully you guys all have a good day. Catch you next time. This is Finding Value.